How do Incoterms define insurance responsibilities in freight? Imagine you're sending a package across the world. Who's responsible if it gets lost or damaged? That's where Incoterms come into play, guiding who handles insurance and risk. Incoterms are a set of internationally recognized trade rules published by the International Chamber of Commerce. They clarify who pays for costs, who manages risks, and who arranges insurance at each stage of shipping goods internationally. Knowing these terms helps prevent surprises and keeps your supply chain running smoothly. Let's start with the basics. Incoterms split responsibilities between sellers and buyers. The key point is where the risk shifts from one to the other. That transfer point also determines who should insure the goods. Not all Incoterms requiring insurance, but some specifically say who must handle it. This makes it easier to plan and avoid misunderstandings. Take the Incoterm called cost, insurance, and freight, or CIF. This one is used mainly for sea and inland waterway shipping. Under CIF, the seller must deliver the goods on the ship at the port of shipment, pay for transportation to the destination port, and provide insurance coverage for the buyer. The seller's insurance obligation is only for minimum coverage, which protects against major risks during transit. Once the goods are on the vessel, the seller's responsibility ends. From that point, the buyer takes on all risks but does not pay for insurance until the goods arrive. If the buyer wants extra protection, they can buy additional insurance separately. Another common Incoterm is carriage and insurance paid to, or CIP. This applies to all modes of transport, including trucks, trains, ships, or planes. The seller must arrange and pay for transportation to the agreed destination and also provide insurance for the goods. Unlike CIF, CIP insurance is usually all-risk coverage, meaning it covers most types of damage or loss unless specifically excluded. The seller's risk ends when the goods are handed over to the first carrier, but the insurance remains in effect until the goods reach the destination. Now, let's look at CFR, or cost and freight. This term is used for sea and inland waterway shipping as well. The seller pays for transportation to the destination port but does not have to insure the goods. The buyer is responsible for arranging and paying for insurance once the goods are on the ship. The risk transfers to the buyer as soon as the goods are loaded onto the vessel. So, if something happens after that point, it's the buyer's responsibility. Most other Incoterms, like free on board or FOB, carriage paid to or CPT, X-Works or XW, delivered at place or DAP, and delivered duty paid or DDP, do not requiring the seller to provide insurance. With FOB and CPT, the buyer usually arranges insurance. With XW, the buyer takes on all risks and insurance from the seller's premises. For DAP and DDP, the seller might choose to insure the goods until delivery, but it is not mandated by the Incoterm itself. Choosing the right Incoterm affects who manages insurance, which impacts costs and risk management. Companies with strong logistics teams might prefer terms where they control insurance to get better rates or coverage. Others might choose seller-provided insurance to keep things simple. Clear contract terms prevent disputes, uninsured losses, or unexpected costs. In summary, only CIF and CIP requiring the seller to provide insurance. In most other cases, the buyer is responsible for arranging and paying for insurance. The point where risk transfers from seller to buyer determines when insurance responsibility shifts. Understanding these details helps companies manage freight costs, reduce risks, and keep international trade running smoothly.